China's cancellation of 150,000 EV orders has shaken the European automotive industry, leaving companies scrambling for solutions. This bold move underscores China's new economic warfare tactics, intensifying tensions and bringing trade disputes and sanctions into focus. European automakers, who heavily invested in EV production to meet Chinese demand, now face severe financial and operational challenges. This decision threatens to damage Europe's EV industry and disrupt global trade. Europe has long been a leader in electric vehicle technology, with major players like Volkswagen, BMW, and Renault driving sector advancements. However, these companies face significant challenges. Despite Volkswagen's 22.4% market share in 2022, it struggles with declining EV demand, unpopular models, and potential factory closures. Volkswagen is exploring a partnership with Renault to produce $30,000 EVs to address these issues. BMW, which led the market in July 2024, benefits from high demand for its i4 and iX models, capitalizing on the growing interest in premium EVs. In contrast, Renault faces overproduction issues alongside Stellantis and has partnered with Volkswagen on a low-cost BEV project. European EV industry also faces pressing obstacles, including underutilized factories, inadequate charging infrastructure, high green energy costs, a lack of supportive incentives, and increasing resource insecurity. These challenges threaten Europe's long-term success in the electric vehicle market and could hinder further growth in the sector. China has become the world's largest EV market, bolstered by government subsidies, a vast charging network exceeding 10 million stations, and a strong domestic supply chain. With over 100 EV brands and rapid technological advancements, China's dominance continues to grow. BYD, a leading manufacturer, sold over 3 million vehicles in 2023, marking a 62% increase from the previous year. This dominance has intensified competition with European automakers, who are struggling to maintain their market share, both domestically and internationally. China's rising dominance in the global electric vehicle market has led to growing tensions with European EV companies. In response to China's expanding market share, the European Union imposed tariffs of up to 35% on Chinese EVs, arguing that these exports, backed by Chinese government subsidies, are undercutting local prices and distorting the market. In retaliation, China filed a complaint with the World Trade Organization, calling the EU's tariffs unfair, unlawful, and unreasonable. China also proposed negotiations, suggesting the establishment of minimum prices for Chinese EVs as a resolution. The cancellation of 150,000 EV orders from European companies could be a strategic move by China to send a message to the EU about the consequences of such protectionist measures. While China has not confirmed the cancellation, this appears to be part of a broader response to the EU's trade policies, which include tariffs on Chinese EVs and investigations into China's economic practices. Furthermore, China has urged its automakers to pause investments in EU countries supporting the tariffs and explored retaliatory measures like imposing tariffs on European brandy and probing EU subsidies on dairy and pork. If China proceeds with the cancellation of 150,000 EV orders, European automakers would face a significant financial blow, with a potential revenue loss of approximately €6 billion based on an average price of €40,000 per vehicle. This would strain automakers and disrupt established supply chains and production lines. Factories designed for the Chinese market may suffer underutilization and inefficiencies. Shifting production to other regions or adjusting to different market needs could lead to increased operational costs. These challenges may also delay new model launches, raise costs, and further undermine the competitiveness of European automakers in the global EV market. The cancellation could have significant consequences for jobs and local economies in Europe. As demand for certain EV models decreases, manufacturers may scale back production, leading to job losses in factories, especially those focused on Chinese market vehicles. This could affect not only assembly line workers, but also those in the wider supply chain, amplifying the economic impact. Additionally, the cancellation may hinder long-term investments in green technologies and EV innovation, delaying progress toward carbon reduction goals and reducing Europe's competitive edge in the rapidly growing global EV market. Despite the challenges to European automakers, China stands to gain from this shift. Domestic EV manufacturers like BYD, NIO, and XPeng could capture a larger share of the Chinese market, reducing their dependence on European imports. The cancellation may also boost their global standing by leveraging government subsidies, cost advantages, and less competition from European brands. With less external pressure, Chinese companies can focus on innovation, developing models suited to both local consumers and emerging international markets. As trade uncertainties increase between China and Europe, China's domestic EV market could become more self-sustaining, strengthening its technological expertise and solidifying its position as a global leader in electric mobility. Politically, the cancellation of 150,000 EV orders could provoke a strong response from the EU, which may impose stricter trade policies, retaliatory measures, or pursue legal action through the WTO. The EU could increase tariffs or restrict market access for Chinese companies in Europe. Such actions might escalate the trade conflict beyond the EV sector, impacting other industries like technology, manufacturing, and agriculture. Heightened trade restrictions could strain EU-China diplomatic relations, causing ripple effects in the global economy. This dispute may also prompt other countries to reconsider their dependence on Chinese imports, leading to protectionist policies being adopted globally, potentially setting a precedent for future trade conflicts. Experts describe the escalating China-Europe trade tensions in the EV industry as a social war, with significant global implications. Analysts view China's cancellation of 150,000 EV orders as both economic retaliation and a political maneuver to assert its dominance, leveraging government subsidies, strong supply chains, and a vast domestic market. European experts warn that the EU's tariffs could isolate its automakers, forcing reliance on fragmented markets or costly domestic production. This polarization risks stifling collaborative innovation, a key driver of EV advancements. Economists predict broader protectionist trends globally, while political commentators foresee tensions spilling into other industries, straining EU-China relations further. In conclusion, the cancellation of 150,000 EV orders by China represents a significant shift in China-Europe relations, highlighting the growing trade tensions between the two regions. European automakers are facing challenges, including revenue losses, production disruptions, and potential job impacts in the automotive sector. Meanwhile, China is strengthening its domestic EV industry, reducing reliance on European imports and positioning itself as the global leader in EV sales. The global EV market is at a crossroads, with the trade dispute potentially reshaping the industry. The future remains uncertain. Will global cooperation drive progress, or will trade barriers and geopolitical tensions create lasting divisions that hinder the transition to electric mobility? So, what do you think? Will this move push European automakers to innovate and find new markets, or could it spell lasting trouble for the EU's EV industry? And from a global perspective, do you believe these trade tensions will accelerate or hinder the adoption of electric vehicles worldwide? We'd love to hear your thoughts, so drop a comment below and join the conversation. If you enjoyed this analysis and want to stay updated on major global developments like this, make sure to like this video and subscribe to our channel. Thanks for watching, and we'll see you in the next video.